What if the money in your bank account isn't yours? I don't mean what if the bank fails. I mean, what if, by law, the second you deposited your paycheck, you gave up ownership of that money? What if I told you that in the dark halls of legislation, after the 2008 inferno, they didn't just patch the system, they rewired it. They passed a new set of rules. A law. A law that doesn't just allow them, but instructs them to legally seize your savings in the next crisis. This isn't a bailout. That was 2008. That was when they used taxpayer money to save the banks. This is a bail-in. This is when they use your money to save the banks. You've been feeling it, haven't you? The quiet panic. The inflation that isn't transitory. The grocery bills that make no sense. The feeling that you are working harder and harder just to stay in the same place. You think that's an accident? You think that's just the economy? It's not. It's the design. And Michael Burry, the man who saw the 2008 collapse coming when everyone else called him a fool, is warning again. But this time, the crash he sees isn't the real story. The real story is what they've planned for the aftermath. Welcome to the channel. We dig. We look at the fine print. We connect the dots that the mainstream media is paid to ignore. Let us know in the comments where you're watching from. It's good to know how far the truth is traveling. And if you're new here, hit that subscribe button. We're building a community that wants the unfiltered truth. Because what's coming is a financial sleight of hand. And we're about to expose the magicians. To understand the trap, you have to understand the official story they sold you about 2008. The story goes like this. Greedy, stupid banks gave out bad loans, subprime mortgages, to people who couldn't afford them. These loans were packaged up and sold. When the homeowners stopped paying, the whole house of cards collapsed. Lehman Brothers failed. The world economy was seconds from total darkness. And then, a hero? The federal government and the Federal Reserve rode in. They passed the $700 billion TARP program. A bailout. They injected trillions of dollars in liquidity. They saved the day. That is the story. It is clean. It is simple. And it is a complete and total lie. They didn't tell you the real reason the system broke. The subprime mortgages were just the match. The bomb was something else. It was the derivatives. Specifically, credit default swaps. These were the side bets. The casino chips. Banks weren't just losing money on the bad loans. They were losing 100 times more on the bets they had made on those loans. When we were told the problem was a few trillion in bad mortgages, the real exposure in the derivatives market was over $60 trillion. They blamed the homeowner. They blamed the greedy mortgage broker. They blamed the predatory lenders at the street level. They pointed your anger down at your neighbor who lost his house, all while ignoring the institutionalized, parasitic gambling in the skyscrapers that multiplied the risk 1,000 times over. Sound familiar? Then came the solution. We were told, never again. We were promised that too big to fail would be ended. We were promised the banks would be broken up, that regulators would be put on a leash, and that the system would be made safe for the average person. So what happened? Let's look at the receipts. Did they break up the big banks? No, they fed them. In 2007, the top 5 banks in America held about 43% of all assets. Today, the top 5 banks, JP Morgan, Bank of America, Wells Fargo, they hold over 60%. They didn't end too big to fail. They made them too big to comprehend. They are the system. The regulators promised to cut the cancer out. Instead, they fed it. They rewarded the very institutions that caused the collapse, making them larger and more powerful than ever. Does that sound like a system that's been fixed? And that brings us to Michael Burry. In 2006, he wasn't a hero. He was a lunatic. He was an outcast in his own industry. He read the spreadsheets. He looked at the actual numbers inside the mortgage-backed securities and saw rot. He saw the illusion, as he called it. Everyone else saw the narrative. The narrative was housing prices only go up. The narrative was the experts at the Fed have it under control. The narrative was it's contained. Burry saw the numbers. The numbers said the system was a hollow shell. And now, he's warning again. He's screaming from the rooftops about runaway inflation, about market bubbles, about systemic rot. And once again, the narrative is don't worry, everything is fine, the Fed is handling it. Inflation is transitory. It's the same pattern. But this time, there's a difference. A horrifying difference. In 2008, the system broke, and they had to ask Congress for the money. It was messy. It was public. It was bad PR. The people were furious. The elites, they don't like bad PR. They don't like having to ask for permission. So, they decided, in the smoking ruins of 2008, that they would never have to ask again. They would just change the law. They needed a new mechanism, a way to recapitalize the banks without a public vote, without going to Congress, without the messy headlines of a bailout. They found one, and they hid it. They hid it deep inside the single largest piece of financial regulation in modern history. A 2,300-page monster of a bill passed in 2010. It was called the Dodd-Frank Wall Street Reform and Consumer Protection Act. They told you this was to protect the consumer. They told you this was to end too big to fail. But buried inside, under Title II, they wrote something called the Orderly Liquidation Authority. Orderly liquidation. It sounds so boring, so bureaucratic. It is the single most terrifying phrase in the financial dictionary. Because this authority does something that has never been done before. It fundamentally and legally changes your relationship with your bank. Before Dodd-Frank, when you put $10,000 in a checking account, that money was legally yours. The bank was a custodian. They were holding your property. After Dodd-Frank, the moment your paycheck hits the account, that money is no longer your property. It becomes an asset on the bank's balance sheet. You are no longer the owner of that money. You are just another unsecured creditor. You are a lender. You gave the bank a loan of $10,000, and in exchange, you get a promise to be paid back, an IOU. This is the legal trap. This is the switch. Because when a bank fails, who gets paid first? The secured creditors, the insiders, the other banks. And who gets paid last? The unsecured creditors. You. This single, legal redesignation of you from owner to creditor is the entire game. It's the mechanism that allows them to pay for the real problem, the one they never fixed, the one that's 1,000 times bigger than subprime mortgages, the ghost in the machine, the $700 trillion time bomb. And the law that makes it all legal? It has a sister, a global framework. You won't believe the name they gave to this new global standard. This is the core of the illusion. This is the part they pray you never understand. The 2008 crisis, the one that nearly ended the world, was caused by derivatives. But the derivatives market never went away. In fact, it's bigger, more concentrated, and more dangerous than it has ever been. What is a derivative? It's not a thing. It's not a stock, not a bond. It's a bet. It's a side bet on the outcome of a future event. Imagine two giants in a dark room, making bets on a football game. But the bets aren't $100. The bets are $100 trillion. And the room is over the counter, meaning there is no regulator. No one watching. No one making sure they actually have the money to pay the bet. This is the OTC derivatives market. And the size of this shadow casino is staggering. The Bank for International Settlements, the central bank of central banks, gives a conservative estimate. Statistic number 1. The total nominal value of the global over-the-counter derivatives market is over $700 trillion. Let's put that number in context. Statistic number 2. The entire GDP of every country on Earth combined is about $100 trillion. Statistic number 3. The entire M2 money supply of the United States, every dollar in every checking account, savings account, and cash, is only about $21 trillion. The bets in the shadow casino are 7 times larger than the entire world's economic output. They are 33 times larger than all the actual money in the US system. This is not finance. This is a doomsday machine. It is a daisy chain of parasitic finance. JP Morgan has a bet with Goldman Sachs. Goldman has a bet with Deutsche Bank. Deutsche Bank has a bet with HSBC. HSBC has a bet back to JP Morgan. They all owe each other trillions that don't exist. It's a system of pure, unadulterated moral hazard. As long as the music plays, they collect billions in fees and bonuses. They create no value. They build no factories. They invent no new technologies. They just skim. But what happens when one of them stumbles? What happens when one link in that $700 trillion chain breaks? The entire system implodes. Instantly. This is what the elites are terrified of. This is the wolf they are constantly trying to keep from the door. And they know they can't bail it out. You can't bail out $700 trillion. There isn't enough money on the planet. So, they had to invent a new plan. The bail-in. If they can't get the money from the outside, taxpayers, they'll take it from the inside, depositors. This is the orderly liquidation from Dodd-Frank. Here is how it will happen. And it will happen fast. Step 1. A major bank, let's call it global megabank, is on the verge of failure. Its derivative bets have gone bad. It owes trillions it doesn't have. Step 2. The regulators step in. The FDIC. But the problem is too big. Statistic number 4. The FDIC's Deposit Insurance Fund, the money pot that's supposed to insure your deposits, has about $128 billion in it. That $128 billion is supposed to cover over $18 trillion in deposits. It's not just a rounding error. It is a joke. It is an illusion of safety designed to keep you, the customer, calm and docile. Step 3. The FDIC, knowing its fund is useless, triggers Title II of Dodd-Frank. Orderly liquidation. Step 4. The seizure. The bank is seized on a Friday after markets close. The government declares that to stabilize the bank and prevent a systemic collapse, the bank must be recapitalized. Step 5. The bail-in. The bank's unsecured creditors will have their claims converted into equity. And who is the primary, number 1 unsecured creditor? You, the depositor. Your $50,000 in savings. Poof. It's gone. It's not seized, you see. That's messy. It's converted. They take your hard cash, and they give you stock in a bankrupt, worthless, dead bank. It is the greatest, most devious, most evil act of financial warfare ever designed. They engineered a system of unfathomable greed and leverage. They privatized all the gains, and they wrote a law that socializes all the losses and forces you to be the bag holder. And if you think this is just a conspiracy theory, you aren't paying attention. Statistic number 5. This isn't theory. It's precedent. In 2013, the banks in the nation of Cyprus failed. They had made bad bets. The EU and IMF refused to bail out. So, they triggered the world's first modern bail-in. They locked the banks, froze the ATMs. Over one weekend, they restructured. Anyone with over 100,000 euros in their account had their money seized. Up to 47.5% of their uninsured deposits gone, snatched, converted into worthless bank stock to pay the bank's gambling debts. People went to bed on a Friday as citizens. They woke up on a Monday as unsecured creditors. It worked so well that the global elites decided to make it the official plan. In 2014, the G20 nations, the 20 largest economies, including the United States, met in Brisbane. They all signed on to a framework agreeing that bail-ins would be the new, preferred tool for handling bank failures. It's not a secret. It's not a conspiracy. It is the openly stated, globally agreed-upon plan. This is the Great Reset Michael Burry is warning about. It's not just a crash. It's the response to the crash. The moral hazard is complete. The illusion is total. The banks get to keep the $700 trillion casino running, knowing, with full certainty, that when the house of cards finally falls, their losses are already covered. By you. So who are they? Who are the architects of this generational theft? This isn't just a system error. It is a design. It's a game of two-faced morality, and the architects are the ones who own the casino. First, you have the central planners. The Federal Reserve, a private banking cartel that poses as a government agency. Their stated goal is price stability. Their real goal? The total control of the economy. They create the booms and the busts. They print money from nothing to fuel the derivative bubbles. And then, when the bust comes, they are the ones who manage the crisis. Their crisis. Second, you have the inside men. The regulators. The people at the Treasury, the SEC. Look at the revolving door. The CEO of a bailed-out bank becomes the next Treasury Secretary. The regulator who missed the fraud at Lehman Brothers gets a 7-figure job at JP Morgan. It is not incompetence. It is collusion. They are not regulators. They are gatekeepers, ensuring the system works for the insiders. And third, you have the political class. The senators who voted for the 2,300-page Dodd-Frank bill. Do you think they read it? Do you think they understood Title II? Of course not. They were told to pass it by their donors, the very same too big to fail banks that wrote the legislation. This is the illusion Burry talks about. The illusion is that you are in a market. You are not. You are in a managed system. And here is the proof. Here is how we know there are two sets of rules. Look at the repo market. In September 2019, the plumbing of the financial system suddenly choked. The repo market, The critical overnight lending market that banks and hedge funds use to fund their daily operations froze. Did the Fed let it fail? Did they say, "That's a bad bet, you're on your own"? No. They immediately and quietly opened the taps. They flooded this shadow market with billions, then hundreds of billions, and eventually trillions of dollars in overnight loans. A secret bailout. No headlines. No congressional vote. For their friends, the hedge funds and primary dealers, there is endless, free money printed from nothing. A perpetual bailout. For you? For the unsecured creditor? They wrote a law called the bail-in. There is a system for them, and a system for you. And why isn't this the lead story on every news channel? Why aren't politicians screaming about this? Ask yourself, who owns the media? The same institutional investors. The same massive asset managers. BlackRock, Vanguard, State Street. They own the media corporations. They own the pharmaceutical companies. And they own the banks. It's one big, happy family. It's a club. And you are not in it. So what do? We are trapped in a system built on an illusion. An illusion of deposit insurance. An illusion of regulation. An illusion of ownership. The 2008 crash was slow motion. It took months to unfold. The next one, the one this bail-in mechanism was built for, will be fast. It will be digital. It won't be a slow crumble. It will be a circuit breaker on a Friday afternoon. You will go to your ATM, and the screen will just say, "Unavailable." You will try to log into your bank account, and the page won't load. By Monday morning, the rules will have changed. The conversion will be complete. And this system, this is just the transition phase. The bail-in is the tool they'll use to clean up the old, failing system. The new system they are building to replace it is even more sinister. Central bank digital currencies, CBDCs. A world where they don't need to bail in your money because they have a switch. A world where your money can be programmed to expire. Programmed to be unusable for things they don't approve of. But that is a story for another day. The final, philosophical lesson here is about denial. We are in a state of mass denial. We want to believe the FDIC sticker on the bank's door means something. We want to believe that experts on TV are smart and have our best interests at heart. We want to believe that this system, this American dream built on borrowed time, is real. It is not. It is an illusion. It is a system of parasitic finance that has detached from reality, and it is now eating its host. The host is you, your savings, your children's future. They are counting on you being asleep. They are counting on your denial. They are counting on you to trust the institutions that are actively, legally, setting you up for the slaughter. So what's the first step? Waking up, reading the fine print, questioning the narrative, understanding that the system is not your friend. Share this video. Send it to your family. Send it to your friends. The media will not cover this. The politicians will not talk about this. You are the new media. You are the new information network. Hit that subscribe button. We are just getting started.